it's Jason Hartman back with a lesson on sales economics. So we talked before about how supply and demand is of course, the fundamental rule of economics. Well, in this lesson, we're going to dive in. We're going to learn some of the key factors that move market prices in an area up, down, and sideways. No, not really. Well, yeah, I guess so. We're going to understand the factors that cause submarkets. These are the micro markets within a given what's considered to be a market. Now, you might be asking at this point, what the heck does market mean? Well, the answer is, I don't know, because it's kind of subjective. We might talk about a market as an MSA, a metropolitan statistical area. We might talk about it as a city. We might talk about it as a town. We might talk about it as a big region or a state. So I think when I'm referring to it, I'm probably thinking that you should view it as an MSA, a metropolitan statistical area, which can include several cities, okay? So within those cities, of course, even the city is not a micro market unless it's a really small city, but within those areas, there are micro markets that are more like neighborhoods that have certain characteristics. And sometimes they perform differently than the overall market. So we've got to understand that. What are the factors that move market prices up? Well, obviously in-migration of people and in-migration of employment. So when the jobs come, the people come, and usually the jobs go first and then the people follow. New development, and that's largely dictated by land use, the regulatory climate, the zoning laws. And this new development could be very affordable, and that could attract people to an area, or there could be really nice amenities, and that could attract people as well. So many factors there. Low costs of doing business, especially for startup companies. Now, of course, you probably have seen in the news stories about large companies like Boeing, Boeing Aircraft moving, or many other large companies that have moved over the years. And many have moved from places like California that are not very business friendly to places like Texas, which are much more business friendly. Obviously, it's very advantageous for a company to be in a low cost, business-friendly, easy regulatory environment so that the government is not hassling them all the time, and the companies and entrepreneurs can do their thing without a lot of interference and intrusion. So prices naturally rise when people and jobs are moving into an area with limited space available for new construction. Now, remember my riddle about the environmentalist and the developer? Well, I'm not going to tell you the riddle again because, at the risk of repeating myself, but it was on a prior lesson, and that's exactly what that is, okay? Another key factor, of course, is the cost of doing business, and that's a big attractor for startup companies. And many cities and municipalities and counties and even regions offer incentives. They're very smart in courting these businesses and offering them incentives to come in and set up shop there or to grow there and make it easier for them to grow. So that certainly happens as well. One of the things, though, I want you to understand as we're looking at this lesson is that, well, all of this is true. We like areas with limited supply, maybe in a valley or a certain region where the development can only go so far. But that's not the only factor, obviously. We have to take into account what we learned early in the course when we talked about rent to value ratios, because of course an area like my area where I live in San Diego, in the submarket of San Diego called La Jolla, and there are even, I'd say, submarkets within La Jolla. La Jolla, California, very expensive market, and even though supply is constrained, it's limited, and there's not a lot of opportunity for new growth and new development, and nobody can build a new tract of homes here. Even though that's all true, it doesn't mean it would be a good place to invest, because you can't get the cash flow to work. You can't get the numbers to make sense. The rent to value ratios are not attractive to investors at all. So again, That's another factor you've got to overlay onto this whole topic, okay? So obviously outmigration is going to push prices down, loss of jobs is going to push prices down, lots of new development, a glut of new development in an area, especially in the residential market, but certainly true in the commercial market too. I remember just a few years ago when my company leased a new office space, there was a glut of office space on the market, and we got a pretty good deal on our office lease because there was just a lot of supply out there. And high cost and regulations for business are, of course, either going to keep businesses away, or if they're there already, it's going to drive them out. Prices will naturally fall when these things happen. So you don't want to see any of these things in an area if you are looking for price appreciation and capital gains. So highly burdensome taxes and regulations, they also drag on this as businesses struggle to survive. So I think you get the idea about that. So why do now this is a particularly interesting part of this lesson. Why do submarkets perform differently than an overall market? We could also call these micro markets. So let's kind of examine this. So changes in migration and employment that are too small to impact the overall market, but they can have a big impact in a submarket because a submarket is a pretty small place. And even a fairly small company coming in and going into business and opening up shop or going out of business can really affect a submarket. In La Jolla, California, if you have a popular restaurant and a new coffee shop open on the main street in town, that actually impacts the market. It really does. So small things can really be meaningful in small, micro, or submarkets. Landlocked submarkets with neighborhoods on all sides experience significant price swings as demand changes because the supply is fixed. So you're only really looking at one factor. Now, do be careful because in an area I used to live in Orange County, California, called Corona del Mar. At one time, most of the houses in Corona del Mar were just little beach cottages, but then the city became more liberal and made it easier for people to subdivide their lots into condos and have their single-family home zoned as 2 condos. And developers would come in seeing the profit opportunity, and they would scrape the old single-family little beach cottage off, build 2 condos, and sell them for a lot more and probably make a nice profit. And that changed the supply dynamic. So even though you look around and you think there's not any new development going on here, yeah, there is. There's small new development because if 50% of the houses in a given submarket convert from 1 to 2 units, well, that changes things, doesn't it? Okay, so keep that in mind. Now, employers moving into a submarket, of course, they're going to drive up land values usually, and the developers will be bidding for any vacant land, if there is any, and they will be bidding up the prices, and that'll cause the housing prices to rise, the commercial real estate prices to rise ultimately. But at first, when they come in and they add supply to the market, it will usually cause prices to soften as you have more supply. And again, note that softening is relative to what the overall market and the overall MSA is doing, because the market may be on an upswing dramatically, and a new development comes in where it would otherwise go higher if that new supply wasn't there. But this will soften it even though it's softening on an upward trajectory. So understand that too. That's a good distinction to know. So swanky neighborhoods that attract people who are willing to pay higher prices to be near, restaurants, art galleries, nightlife, coffee houses, all this kind of really cool stuff in neighborhoods, that definitely can have an impact, no question about it. So what are some of the key points here? Well, market prices are moved by the ratio between the number of willing buyers and the supply, I really should say willing and able buyers, they got to be able to buy even if they're just willing, and the supply of property for sale. So this means that prices will go up or down much faster in a market with limited new construction. Because remember, if the supply is fixed and the demand changes one way or the other, it can go both ways, of course, that is going to have a pretty big swing on the market. These swings tend to be big, and these also, by the way, bringing you back to one of the very early lessons in the course, tends to make these markets cyclical and less linear in nature, or at least make them hybrid. Remember our 3 market types: cyclical, linear, and hybrid. Okay, always keep the availability of supply in mind when purchasing property. Remember the Corona Del Mar example where the 1 unit converted to 2, okay, because you definitely got to watch little sneaky things like that can really change the game. And when purchasing property in a landlocked micro market, it's important to understand if people will continue to move in. Maybe housing prices will just drive them away and no new employers will move into that market because the cost of doing business is too high, because the salaries that they have to pay for people to be able to afford to live there are just too high. When purchasing a property out in the suburbs around a major city, it's important to understand the velocity of new development. I underlined the word velocity because that's key. The speed of new development. Is there a lot of it happening? Is it happening quickly? Or is it at a very slow, leisurely pace? So, supply and demand and sales economics. Here are your action items. Research the volume of sales transactions in a given area. You pick the area, and maybe it's a market that you want to concentrate on. You've always had that choice in most of these assignments throughout the course, and look at the directions of the price movements, and just write us a little paragraph or two about that, and tell us about the supply and demand and what it is telling you as the potential investor. So research this transaction volume, the price movement, using the provided document, explain what the data is telling you about the supply and demand of properties, and upload a screenshot. Just take a screenshot, upload it, you'll have your badge, and I'll talk to you on the next lesson.